Today, folks, is a financial clown on the internet that advocates toward drinking 20-cent instant coffee over a $5 Starbucks because I know at a compounded rate of return of 11%, say from something like the S&P 500 at $5 a day, 365 days a year, you do the math, that leads to retirement-like money just from saving $5 on coffee. But I'm talking about this because this brand specifically is crashing miserably. In fact, Nestle is the largest food conglomerate in the world, and it's not often I talk about consumer staples because they're supposed to be considered the recession-proof stocks, the safe haven investments during volatility from, say, tech and bubbles that exist in the market. But today they are crashing. A lot of them are in the toilet, and people are asking themselves, are they true buying opportunities to get higher than average yields and expected recoveries in the future? And that's the question we're asking today. So if you're on the path to financial independence, if you damn well one day want to retire early, join me on that journey by simply hitting that subscribe button, folks, if you want to generate that juicy dividend, that wonderful passive income, because not all of these companies are created equally. And in this market, tariff war, commodity fluctuations, Mandalay, Unilever, Coca-Cola. I mean, Coca-Cola is sitting at all-time highs. Some of these companies have absolutely crushed, but we're going to be talking about Nestle, Pepsi, and basically Hershey's stock because they've cratered. They've absolutely cratered. And in the news, people are picking it up. We're seeing like multi-million-dollar buys for major hedge funds, right? So if you take a look, Pepsi right now is trading off its highs by roughly 35%. That is not a small drop. In fact, Pepsi's only seen drops like that a handful of times throughout its history, one of them being the 2008 financial crisis. So the question we got to ask ourselves is, should we buy it on the expectation of a recovery and to lock in a 4.5% almost yield? Now, it's not cheap by any metric. Pepsi still trades at quite a wicked valuation considering the bottom line fundamentals aren't growing, and it typically always trades at a premium because, again, these brands aren't going anywhere. But there is some concern as guidance is starting to change. I mean, we've seen the largest consumer conglomerates are now cutting their financial forecasts, basically predicting lower sales and profits than before, including Pepsi, Kimberly-Clark, Procter & Gamble, and a lot of this on the back of the tariff war, which we'll see when we look at Pepsi's guidance, because this is the first material drop we've seen on a year-over-year basis, with net revenue going from 18.25 billion to 17.9. I mean, if you take a look at the net income here, from 2.05 billion to 1.84 is not a small drop. I mean, this is quite a material dip in their earnings, and it's quite impactful. So we take a look at the guidance kind of driving some of this. For 2025, the company continues to expect low single-digit increase in organic revenue, which is great. So a little bit of revenue growth here, but core annual effective tax rate of approximately 20% and total cash return to shareholders of approximately 8.6 billion, comprised of dividends of 7.6 billion and share repurchases of $1 billion. I'm kind of sad they're not doing a largest share repurchase. In times like this, it's nicer seeing companies really gobble up cheap shares. We're seeing big tech companies like Google doing this right now, but they might not have the same kind of liquidity, and they know people are holding the stock for the dividends, specifically, in my opinion. So, guidance is getting kind of weak, but the company's pretty strong. I mean, again, if you look at revenue overall, they're still expecting at least some revenue growth here, which is great to see. It's just the fundamentals, the margins are kind of getting eaten away a little bit. If we take a look at the quarterly, I mean, we can kind of start seeing that on an annual basis with a little bit of the revenue drop. So I'm really not sure. Pepsi's a pretty strong company. If you look at the statistics, their profit margins are reasonable for consumer staples. If we take a look at analysis and see what the analysts are expecting, I mean, the analysts have price targets as low as 110 to 170, with the average at 151, and we're kind of at the lower end of that right now, hovering around this 130 mark. So I wouldn't say it's on sale. I wouldn't say it's a screaming buy opportunity here, but it is paying a pretty decent dividend that is pretty reliable. If we take a look at the statistics again, currently the payout ratio is probably sitting somewhere, well, it's getting a little higher at 79%, which is higher than where it has been historically as well, I believe. But again, I still think the dividend's reliable, and it is a great company to look at with almost 80% institutional ownership. I don't know. I'd love to know what you guys think about Pepsi overall. Now, I'm going to share with you which of the three is my favorite and that I would buy today, but we'll kick it off with Hershey, another major food manufacturing company in the chocolate sector, and this one's down worse than even Pepsi. It's down 43% with a 3.5% dividend yield. These are the highest yields these companies have paid out in a decade plus. That's why a lot of people are paying attention to them right now. And this one, I think, has one primary indicator to when to buy it, because this is why Hershey sell-off is a buying opportunity according to Motley Fool. I'm not going to read through this article too in-depthly. They're just saying it's a strong company that's working on kind of doing some major adjustments right now. But when you look at the cocoa prices, this is the end-all be-all defining factor. Regardless of the clickbait titles that try and drive you to buy the stock, I always said that if you want to buy Hershey when you start seeing a turnaround in cocoa prices, because cocoa prices are literally sitting at, I can't even see it, but literally like all-time highs. Like this, I have to pay to see a 25-year chart on cocoa prices from basically trading economics. But still, these are like unbelievable highs led to like major weather patterns where they mainly produce cocoa, which is the primary product in chocolate, obviously, and Hershey is primarily a chocolate and candy oriented company, right? So this is kind of detrimental and has been absolutely deteriorating their earnings, as we'll see. First and foremost, if you take a look at Hershey's financial results here, consolidated net sales decreased by 13.8%. Organic constant currency net sales decreased 13.2%. Reported net income, my goodness, was down 71%. This company is not doing well. Even the adjusted earnings were down 31.9%. But if we look at the full year financial guidance, net sales growth is expected to be at least 2%. Reported earnings per share are going to be down in the high 40% range. So basically, they're getting absolutely clobbered, and they're claiming that this has a lot to do with the tariffs, which is basically expected to impact them by 15 to 20 million in the second quarter. Other expenses, which primarily reflect the write-downs of equity investments that qualify for tax credits. So perhaps some of the earnings decrease has to do with some of these write-downs, which is expected to be 170 to 180 million. Interest expenses are incredibly high with the current interest rates, but I imagine, depending on where Hershey's based out of, because I do believe it's not a U.S. company, I think it's a European company, we need to see how those interest expenses are affecting them. They have capital expenditures of approximately 425 million. Like, they're in a phase of adjustment right now that is pretty extreme. So the question is do you believe they're going to get through this and come out on the other end of it surviving? Because to be honest, if you take a look at their annual revenue, it's still been pretty strong overall. So, again, like Pepsi, they do have a strong fundamental core, which is great to see. And again, I mean, if you just ask yourself, kind of what's going on here, why the sales are decreasing so dramatically, there's a lot of questions that you have to ask yourself about this company, which why right now, the only thing that I can say is you need to see cocoa and commodity prices start to recover before you could really dive into this comfortably. It's still a very sketchy place. I mean, the price to earnings multiple is still incredibly high to some extent. So just be aware of that. Just pay attention to the company and see how they go through some of the restructuring they're doing. Along with the commodity prices. But I will say, and we will finish on the one that I am absolutely willing to buy today. I haven't been buying it, but you have to ask yourself, man, when it comes to these commodity or these consumer staple stocks that are affected by commodities, but what one has the most diversity, what one's been the strongest and the most resilient, but is trading at the best discount today, and that has to be Nestle. Again, coming back to the cheap coffee that I drink, Nestle is a massive conglomerated company, and its stock is trading down quite hefty. I mean, it is down 30% today. It's not cheap at a 21, PE ratio, but the dividend yield looks pretty attractive here. And as we dive into the earnings, Nestle has had some concerns with their own insiders kind of throwing flack at the new CEOs, but the boss says that his predecessor weakened the fabric of the company, which is really interesting here, saying that basically they were turning to, basically, let's just read this real quick, forays into the news product categories that includes health supplements that weaken the fabric of the organization, as he ruled out turning to major acquisitions or asset sales to boost growth. Basically just saying that they were looking at health supplements instead of just doing what Pepsi and many of these companies do, because they can't just make new brands. It's really hard to get accretive growth anymore in consumer staples without massive acquisitions of other companies. I mean, that's why you can see companies like Google that can innovate an AI product that can immediately drive billions of dollars worth of sales. But with these consumer brand companies, these consumer staples, these foods, you really need to buy some other, asset out there that can really add bottom line growth. We've actually even seen this with financial institutions like Royal Bank here in Canada. But there's no way a food company can just come out with a new product and turn it into $1 billion thing in a year. So they're just saying that they should be focusing on some other things, which is really interesting, a bit controversial. But overall, again, if you look at the annual sales of Nestle, they have been incredibly strong. They are down slightly, but year over year, they're actually up quite materially. So for this annually, I mean, if you look at 2021, they were doing 87 billion, and today they're doing 91 billion, and their gross profit still remains fairly strong overall. So the company's been in a good place, and the performance in their first quarter is in line with their expectations, and our 2025 guidance remains unchanged. But they are claiming that they are going to be impacted by the current tariffs and their ability to adapt, the indirect impacts on consumers. But again, you read into it, and their organic sales grew basically 2.8%. So the company is growing. It's not seeing a huge deterioration as much as, say, Hershey's is. So it is a neat company to look at. It is surviving this quite nicely, but they do have a much more global presence than I think some of these other companies might have. And they are an international company, which does give you some global diversity as well. But yeah, I'm shocked at how well they have been doing. If you take a look at the pricing led growth, quarter over quarter here has been still quite stable on the back of a very, very volatile market. If you just take a look again at the 2025 guidance that has been unchanged, they're claiming that it remains unchanged based on their assessment of the direct impact of current tariffs and our ability to adapt. Organic sale growth is expected to improve compared to 2024, strengthening over the years. We continue to deliver our growth plans, and margin is expected to be at or above 16% as we invest for growth. Overall, the situation continues to be dynamic with heightened risks and uncertainty, but overall, again, this stock is actually guiding through this quite nicely, and it's still down quite materially. So you're never going to buy these companies at any kind of major discount, in my opinion. They're always going to trade at somewhat of a premium. But if you're looking for very long-term, stabilized, diversified income, I don't think it gets more diverse and more conglomerated than Nestle does, and especially for it to be down this much overall. Again, we're not talking about a growth beast. I wouldn't be buying this for like unbelievable expected growth and insane rates of return. Let's see what analysts have for this company right now. Like, what are analysts guiding overall? I think they're sitting at between 93 and 117. We're currently at 103. We're kind of right in the middle of analyst expectations. But yeah, I think Nestle's one of the most intriguing companies out of all of these right now, because I don't want to chase the ones that are flying at all-time highs like Coca-Cola has been, the ones that have been, catching a bid and doing very well. And I'd say like Pepsi's kind of the in-between. Hershey's the one where you got to see cocoa start to recover, and Nestle's just the one that I think is most favorable for the price that it stands at for getting through this and the diversity that it does offer. But I'm always intrigued by these stocks, and I'd love to know what you think about them in that comment section below.